Okay, good afternoon, everyone, and welcome back to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and today we're going to be talking about trading earnings because earnings season is just getting kicked off. We've had a very good performing Q1 for those of you that are invested in long-only equities with very low volatility, almost pretty much a straight line up since the December lows. So the markets are a little overextended. There's a bit of in my opinion, almost a fear of everyone piling in because of fear of missing out, because we've had no pullbacks whatsoever. The market just keeps marching on higher, which does add some additional structural risk as far as potential pullbacks and how quickly those can come. So the fact that we're entering earnings season, I think, is important to look at, because as we enter earnings season, we expect volatility to pick up, and we want to make sure that we are positioned correctly for it, both on the upside and the downside. So really, to look at trading earnings, most importantly, what we want to explore is how do we actually leverage this new volatility or capture some of this volatility coming out from earnings, but do so in a way to and still limit our risk. Because earnings season, even though presents a lot of opportunities to us, also presents a lot of risk. So it's really important to understand how to mitigate that risk by utilizing options. We're going to keep things really simple here today. I'm going to spend just a few minutes on the slides. I want to try to spend as much time as possible going through real examples of stocks that are reporting earnings in the next few weeks and walking you through different trade setups and showing you how to compare different types of strategies so that you can not only learn how to trade earnings through this webinar, but also feel that after you finish this webinar, you have the confidence to do your own analysis using tools such as OptionsPlay. So this webinar is recorded. I will send everyone the slides along with the recording about 30 minutes after we finish here today. So it really allows you to study this or review this material after the fact if this is relatively new to you. So before I get started, I just want to remind everyone, for those of you that are brand new to OptionsPlay, you can sign up for a free 30-day trial to OptionsPlay, the software that we'll be showing you towards the end. Membership of this is only $50 a month or $500 a year. We are introducing a free 12-step options trading course, as well as our daily trading options ideas for those of you that are brand new to OptionsPlay. You can sign up for that through this link, which I will add to the chat window right now, just for those of you that are brand new and do not have a free trial or a subscription already to OptionsPlay. So I will come back to those links at the end for those of you that are starting out here with OptionsPlay. So number one, what we're going to talk about is we're going to look at the earnings season. We're going to look at what we're expecting as an earnings preview. We'll also take a look back as far as what we saw in Q4 of 2018. Certainly that was an interesting quarter. This is really the first time I think we've seen a huge structural shift to what our expectations for earnings was in Q4, as well as what we're seeing in Q1. For the last, I would say, almost 4 or 5 quarters I've been doing these earnings webinars, we've pretty much seen the same theme, where basically both earnings and revenue numbers were growing and growing and growing and growing until Q4. Q4 was the first quarter where we really saw that growth slow down. And we're starting to see it pick up a little bit for Q1. So what I want to do is look at what did we see in Q4? What are expectations for Q1? That'll really help set up our mindset or the framework of how we look at the earnings season coming up. Then what I'll do is I'll cover what are the appropriate option strategies for trading earnings season. So how do you actually go about taking your directional view going into earnings with limited risk? And then why should you actually consider trading earnings? For those of you that are already trading it, you probably are familiar with this, but for those of you that have never traded earnings before or avoided trading earnings, I want to talk a little bit about, what should you be looking out for so that you can decide, is this the type of strategy that you want to deploy yourself? And lastly, how do you actually trade it effectively? Meaning, how do you actually deploy your capital as efficiently as possible when you're trading these types of strategies that ultimately have a fair amount of risk? So in order to do that, what I really want to do is spend as much time going through real examples of stocks that are reporting earnings in the next few weeks and showing you how we utilize this tool to analyze these upcoming opportunities to decide whether they are suitable for you or not. So we're going to start off by talking about Q1 earnings preview. Like I said, as we got into this webinar, Q4 was really where we saw a pretty big shift in our expectations or in earnings previews. So in Q4, we really saw growth slow down quite a bit. We saw the smallest beats across the board in the past 3 years. I think the average beat was less than 1% versus on average over the last few quarters was about 4 to 5%. So we the good thing about having a quarter with such small beats of only about a 1% above earnings estimates is the fact that whenever we have a month like that, it's usually followed by a pretty strong quarter. So that's what we're seeing in Q1. We do expect things to shift a little bit back towards growth in Q1. Q4 was definitely a bit of an outlier there in terms of slowdown. We mentioned that tariffs and talking about trade wars was potentially going to be hurtful for the economy, but based on Q4 earnings estimates and Q4 earnings, less than 10% of companies in the S&P 500 reported that they were being hurt by tariffs. So the result of these trade wars are actually slightly smaller than what our original expectations were. And a huge shift in terms of Q4 was the fact that pretty much for the last 4 or 5 quarters, we've seen stocks that beat did not have very strong positive reactions, but stocks that missed had very strong negative reactions. In Q4, that really flipped. In Q4, our earning estimates were revised down before earnings. So going into earnings, the bar was set pretty low. So what we actually saw was stocks that beat had very massive gains, and stocks that missed did not have huge negative reactions. So it's interesting to see if we're going to continue seeing that in Q1, because growth is certainly decelerating by all means. There's no ifs or but about that. However, there is still some growth. It's not that the growth is not there. We're not seeing contraction yet, but we are seeing that growth significantly decelerate. And what that has contributed to now is significantly lower estimates. So that means that, again, the bar has been set pretty low in terms of what our expectations are. So that typically means that there's a higher probability of companies actually beating earnings. And especially since one of the biggest concerns that we had going into last quarter was the concerns that trade wars were going to negatively impact companies' earnings, we're seeing that those impacts are actually smaller than we had originally anticipated. And one of the things that we have seen going into Q1 is that quality stocks and large cap stocks are seeing better strength than small cap stocks. So large cap has significantly outperformed smaller cap stocks. So this particular earnings season, I do think that we should focus more so on the larger cap names, especially the names that are quality stocks from a fundamentals perspective will likely outperform. And the early reports for Q1 so far has been showing pretty flat growth and very muted surprises. So that typically is a pretty good preview. So we're not overly bullish going into Q1, especially since the markets have rallied so much since those December lows. So that is generally my expectation, is that you're not going to see a lot of huge beats. I actually think that there's probably a higher chance that we see some large misses in this particular space. So that's the preview that we're typically expecting to see going into earnings season that pretty much is being kicked off over the next few days. So what sectors do we want to take a look at? So we've looked at which sectors have the highest upward revisions, meaning analysts expecting better results from those companies. And usually upward revisions have a good correlation to performance over that quarter. So healthcare, utilities, and consumer discretionary are sectors that are currently scanning relatively well for this particular upcoming earnings season, versus financials, materials, and energy are scanning fairly poorly for this upcoming earnings season. So those are some of the sectors to think about when you're looking at opportunities in these particular sectors. Which sectors currently are scanning for relatively high performance versus the ones that are scanning for relatively weak performance. Now, this doesn't mean that we won't see a contrarian trade here. I actually tend to think that maybe financials is starting to turn around a little. I'm seeing quite a bit of strength in some of these stocks, or at least bottoming out in some of these financial stocks, as well as even in energy stocks. But I would say financials is one of the ones that I currently personally have more of a contrarian view on versus what the downward revisions are currently showing. So those are some of the opportunities that I want to explore with you guys here today. So talking about trading earnings, what does it mean to trade earnings? So earnings are simply when a company reports its revenues, profits, and forward guidance as to what they expect the outlook going forward is going to be. Now, we generally see that revenues and profits, while are important as to what is going on with that company financially speaking, we tend to see that stock performance over the last few quarters has really been driven by forward guidance, meaning a company's outlook as to what they expect to see going forward. And one of the things that we look at is how much investments are the company making in investing in their future, how much are they paying out in dividends. These are the types of things that we look for to determine whether a stock is going to continue moving higher or lower. So those are some of the things that we want to pay attention to. So why should you pay attention to this? Why should you trade earnings? And the reason for it is because these earnings reports create a binary event that have extreme volatility, meaning if the stock provides good forward guidance, then they are likely going to instantaneously jump in price up higher, and stocks that disappoint are likely going to jump in price lower. And this creates a very significant move in the underlying stock in a very, very short period of time. And if you happen to be on the right side of that trade, that can potentially turn into huge profits or huge losses if you're on the wrong side of that trade. So how can you trade earnings? And the answer to this is really utilizing options, because options allow you to take a directional view in one direction or another, however, allowing you to do it with limited risk. So it's really important to be able to take advantage of the bullish or bearish views that you have on underlying stock, but express that view with limited risk. And options give you that flexibility to do that. So when we're trading options for earnings, you generally want to choose expirations that are at least 2 weeks greater than the earnings date. So one of the things that you want to look for is figure out what day is the company actually going to report earnings, and you want to choose an expiration date that's at least 2 weeks beyond that, because many times a stock, after it reports earnings, they may have an instantaneous repricing of that stock. However, you'll typically see the week after that earnings announcement, there's usually a continuation typically in that same direction. So in order to take advantage of any subsequent moves, you want to make sure you give yourself enough time after the earnings day where you continue to have exposure. We tend to find that you want to go at least 2 weeks out beyond the earnings date in order to trade options with. Now, as far as the actual strategy itself, it's really simple, because with earnings, when you're expecting a large quick move like you are with earnings, it's usually best to simply buy a call or a put. You can trade more complex spreads like verticals or even calendars and diagonals. However, I tend to find that calls and puts are very simple strategies that really allow you to express a true directional view with limited risk. So those are some of the things I want to walk you through here today with some live examples. Now, to trade earnings, it's really important that this is actually, in my opinion, a difficult trade to make, because trading earnings is what I call 1 step forward, 2 steps back. What I mean by this is you have one thing that can potentially work in your favor, while you always have 2 things that are trying to work against you. And you have to overcome those 2 things that are working against you in order to make a profit. So those 3 things that you are effectively playing with, or you have to consider when you're trading earnings, is the fact that, number 1, you have this large stock move based on either a beat or a miss on the earnings estimates. So when the stock beats, it's likely going to move higher. When it misses, it's likely going to move lower. So that allows you to express your directional view as far as which way you think it'll go. However, once the earnings announcement comes out, there is a thing called the volatility crush. What that means is that the implied volatility of an option before expiration will be high. That's what you have to pay to get into the trade. And once the earnings once the earnings announcement comes out, that volatility decreases because the uncertainty around what the earnings numbers are going to be are simply over because they've announced it. So implied volatility in an option will decrease after earnings, and that decreases the price of the option that you've paid for. So this is really something that's starting to work against you as you buy an option before earnings. It's expensive, and once the earnings comes out, they become a little cheaper. So it erodes the value of your option. The second piece that's working against you is time decay. Now, this works against you regardless of whether there's earnings coming up or not, but it is another factor to consider because you have to hang on to that trade through earnings, and in order to do so, you must hang on to this trade, and during that time, you have time decay that works against you. So at all times when you're trading earnings, you have two things that are always working against you: volatility crush and time decay, and you have to be able to call that direction correct. So if you call the direction correct, not only do you have to call the direction correct, but the move on the underlying stock has to be large enough to overcome the volatility and the time decay that you are going to experience against you. So there's quite a bit of things that you have to think about here when you're trading earnings. Is how much am I losing to time value? How much am I losing to that volatility crush? And how much do I have to make back in terms of the underlying stock move in order for me to make any money? And this is really where using our P&L simulator on OptionsPlay helps you answer these types of questions. Now, in order to truly understand these three strategies, I do want to introduce the concept of Greeks. And this is more so from a conceptual perspective so that you understand these are the three metrics to look out for. This does not mean that you need to do the math yourself or do the calculations or know how to do the calculations, because our platform will calculate these metrics for you. However, in my opinion, it's really important to at least understand them from a concept perspective. So there are three very important Greeks to remember if you're going to trade options around earnings, and that's delta, vega, and theta. So delta is simply the change in the price of the option with respect to the change in the stock price. So this is the large stock move that I'm referring to. So the stock moves 10% in your favor. How much money does the option make you? Delta tells you that. So if you see an option with a delta of 0.5, that means for every dollar that the stock's going to move in your favor, the option will move 50 cents in your favor. So the delta is just the ratio of the stock move to the ratio of to the option move. The second is vega, so the change in the price of the option with respect to the change in volatility. So this is the volatility crush that I was talking about. So when we talk about volatility coming down after earnings, how much money does that actually impact in terms of your option? So vega, if you're looking at an option price or an option with a vega of 0.25, that's telling you for every 1% change in volatility, you should expect a 25-cent decrease in the price of the option. And lastly, theta, telling you the change of the option with respect to time. So as time goes marching on, how much money do you lose? So this is the time decay that we're referring to. Theta tells you how much you're actually going to lose to time decay. So if you see an option with a theta of 0.1, that's telling you that this option will lose 10 cents for every single day you hang on to it. So if you hold on to it for 7 days, you should expect to lose roughly about 70 cents in value. So this really allows you to quickly understand, well, if vega and theta are working against me, how much does the stock move has to move in my favor in order to overcome the volatility crush and the time decay. So this is really where we can start looking at some option strategies, and that's where I'll bring up OptionsPlay to actually show you some real examples to calculate that. Again, you don't have to memorize those particular strategies. So next, what I want to talk about are two basic strategies that you would deploy if you have a bullish or bearish outlook on an underlying stock going into earnings. So number one, the strategy that I really think is easiest to deploy in this type of environment is really just simply buying a call or a put. It really allows you to express a bullish or bearish view with unlimited profit potential. This is a strategy where you're really expecting a big move in the underlying stock. And this strategy does put a typically larger amount of capital at risk. So that is one of the downsides to outright buying a call or a put. But it really gives you unlimited profit potential over a short period of time, which from my perspective is really the type of exposure that you want when you're trading earnings. You want to take exposure in something that might move really large and be able to take advantage of that. However, for those of you that may not expect such a large move on maybe perhaps a larger cap stock where you know that the stock's not likely going to jump 10%, it might jump 4 or 5%. This is really where buying a call vertical or a put vertical may be more suitable. This will give you limited profit potential, and it's suitable for more of a modest or a slower move in the underlying stock, but it does put a smaller amount of capital at risk. So especially if you're not too confident in the move and you're not sure that it's going to move a huge amount, and it's not a biotech stock or it's not a stock where you typically see large moves, buying a call or a put vertical is another way to express that directional view, but doing so with a smaller amount of capital at risk. And once again, you want to pick expirations that are at least 1 to 2 weeks after earnings for any of these types of strategies. So with that, what I want to do is I want to jump over to OptionsPlay. I want to show you how this platform allows you to instantly select bullish and bearish strategies. And what I really want to spend the most of my time on is really showing you the P&L simulator. It is the core of this platform in showing you how to better understand each strategy, the potential risks and potential rewards, and understand break-even analysis, and even a trading checklist for those of you that are beginners for this particular type of strategy. So let's jump over to OptionsPlay. As you can see here, I have a chart of the S&P 500. The S&P 500 bottomed here in late December, around 230 or so, and it's rallied all the way up to about 290 over the last 3.5 months. So this has really been quite a run since that December low, and pretty much every single time we've had even a small pullback, there's been a huge amount of inflow into the markets back to the point where I feel that this trade is actually quite crowded. And I think there's probably some opportunities for a pullback, and I bet pullbacks like this may be quite fast and violent. So one of the ways to be able to potentially profit from that is going into earnings, looking at stocks that may miss on earnings or perhaps is a little overbought, or stocks that are a little overvalued. So what I want to do is I just want to look at a list of symbols. I want to take a look at potential opportunities here. So I'm looking at United Health Services. This is in one of the sectors that screen relatively well in the healthcare sector. This stock has really been fairly range bound between 131, 135. So it's been trading in a very tight range for a while. So, on earnings, I would expect that perhaps you would see either a breakout back up to that 142 level, or maybe even a breakdown down to the 127, 125 level. So either way, I think this is a potential play for a big move on earnings. So here on United Healthcare, this stock reports earnings on April 24th on the 13th. So for those of you that are brand new to OptionsPlay, this platform is divided into 3 sections. We have trade ideas, watch list, and portfolio on the left-hand side. The middle panel is our security analysis panel. And on the right-hand side, we have trading and income. And the trading tab, which is what we're going to spend our time here today on, is really driven off of the settings that you create here at the bottom. So you can either select I'm bullish on United Health Services, or you can select I'm bearish on United Health Services. So let's for 1 second take a contrarian view and say, maybe this is a little overpriced. The stock has really rallied and it's been trading in this tight range. What happens if we do see a miss and the stock pulls back? So when I select I'm bearish, I can short the stock, I can buy a put option, or I can buy a put spread. So I was thinking that this stock, if it was to pull back on earnings, it'd probably make a crack at that 127 low, or perhaps that 125 support area. So let's put that into the P&L simulator here at the bottom. This allows us to simulate where we think the stock will go by which date. So this stock reports earnings on April 24th. So maybe let's say a week after earnings, the stock is trading at 125. And like we said before, volatility always comes down after earnings. So let's say we have a move in volatility from 24% down to 20%, which is a fairly decent sized move in volatility. How much money should we expect to make? So if we had shorted the stock, we make a 2.6% return, not particularly attractive. Buying a put option, which cost $550, I make an 80% return. Buying a put spread, $470, makes a 100% return. So in this particular case, on a modest move down to about 125, I'm probably better off trading this put spread that gives me a 100% return with a $470 risk, so that even if the stock jumps up to 143, which is where the 52-week high was, as you can see, if I'd shorted the stock, I'm losing $1,400. Buying a put option, I'm losing $521. On the put spread, I'm only losing $441. So in the worst case scenario, I'm losing about $440. In a decent case scenario where the stock does drop down to 125, I'm making roughly, again, $470. So this really allows me to play around with the different outlooks. And conversely, if I'm bullish on the stock, I can take a look at buying a call option. Like I said, I think it'll probably make a run to around 142 if it does make that move a few days after earnings, let's say by the end of April. And again, volatility comes down a little after earnings. Let's say it goes down to about 18% or 19%. Here, as you can see, if I bought the call option, I'm risking $620 for the call option. I make $597 if I do get a modest jump to 142. So that certainly looks fairly attractive compared to buying a call spread, which does decrease my risk, but as you can see, I'm actually making a smaller return on that particular trade. So this is how you can utilize this tool to compare different strategies and very quickly see what is the suitable strategy based on your given outlooks on the underlying stock. Now, I'm not going to spend too much time on each individual symbol. I think I'd rather spend time going through more symbols. So, and I want to look at some symbols that probably either are interesting or have, some big stock names that people are probably familiar with or following. So Boeing certainly is one of those stocks. It's been in the news a lot. This stock rallied off that 360 low, which was the gap before it broke, which was I believe the last earnings announcement. And now it's back to that 360 level. The news coming out of everything out of Boeing certainly is not particularly great. So I do think that there is the possibility that this thing breaks below that 360 level and really makes it crack down a little lower, maybe down to 330, possibly even 300. So for this, I'm going to take a bit of a bearish stance on Boeing and say, well, what happens if I bought a put option, which cost $1,800, which if you think about from the perspective of the fact that that controls about a $36,000 position or $37,000 position, doing that with only $1,800, that's actually a pretty cheap way to take on this bearish bet on Boeing. So if I thought Boeing is going to go down to 330 a few days after earnings, which is on, again, April 24th, and volatility comes down. So Boeing volatility already is quite elevated because of the crashes. So if the stock was to come back down or volatility was to come back down, buying a put option will give me about 131% return if the stock drops to about 330 a few days after earnings. If the stock really makes a big move down to 300, as you can see, about a 300% return on this particular put option. So this is really where I do think that I would certainly be more on the bearish side of things versus the bullish side of things. But let's just take a look at what happens if Boeing does beat on earnings. What happens if it rallies back up to 400? As you can see, if it rallies back up to 400 a few days after earnings and volatility comes down, I'm looking at about a 94, 95% return versus about a 2 to 300% return to the downside. So for roughly the same amount of cost, depending on what your views are, and mine are skewed more so to the downside than to the upside, I certainly think that the put side looks a little bit more attractive than the call side. So this really allows you to look at both sides and see what your opportunities are. Next, I want to look at Apple. I have a bit of a contrarian view here on Apple as well. From my perspective, really not much from this company has changed fundamentally since those December lows, yet we've seen this huge rally from 150 to 200, about a 50% rally. And I certainly wouldn't say that there's a huge fundamental shift in this company since the stock has hit those all-time lows. So let's look at some bearish opportunities here on Apple. Here, this is about a $20,000 position that I'm controlling for 100 shares. I'm going to control that for $820 versus $638 on the put spread. I think that if Apple misses on earnings and falls back, I think easily you can shoot for maybe about a 180 price target. This stock reports earnings on April 30th. So let's say a week after earnings on May 7th, volatility comes back down to the low 20s. Here, if I bought the put option, 140% return on an $820 investment versus 159% return on a $638. So in this particular case, I do think that the bump in the call vertical is meaningful enough to warrant taking a look at the call vertical versus outright buying that call, because selling that 180 call is really going to decrease my cost basis by almost a quarter. So from 820 down to 638, I'm able to save almost 25% on this trade. And as you can see, that really translates to some quite a much higher percentage of return if the outlook that I expect on the stock does play out. And worst case scenario, if this stock beats earnings and rallies, which I think for Apple's is certainly very high, always a possibility. Here I'm risking only $632 versus $814 versus $2,000. So this is really why when you're about to trade earnings, I will almost never buy or short a stock ahead of earnings because of this huge amount of risk that I'm effectively taking if the trade doesn't work out against me. In this particular case, I can make 150, 160% return if I'm right, but if I'm wrong, I have limited risk to what I've paid for that call or put option, really allowing me to express my directional views without taking on too much risk. And that's really the name of the game here when it comes to trading options for earnings, is because you really want to limit your risk as much as possible, and buying calls or puts, in my opinion, is one of the simplest strategies you can deploy and really allows you to quickly understand what your potential risks and rewards are. Pfizer, well, let's look at Biogen. So thanks for the recommendation here. So Biogen, this stock really plummeted on some bad news from trial, from more of the on the pharmaceutical side in terms of drugs that didn't work out the way that it expected to. And, this is certainly one of the sectors that have scanned relatively well. So I do think that there's the possibility that this stock may pop up over earnings. After that drop, it certainly has started to climb a little bit. So I'm not sure how far the stock will go, but let's just take a look. Let's say right now to buy 100 shares of that stock will cost me $23,000. Buying a call option, $1,300. Buying a call spread, $1,200. By the OptionsPlay score, that's telling me these options are pretty expensive. But let's take a look at these options. So let's say I think the stock will rally back up to 275 or so on earnings. So here, as you can see, and this reports earnings on the 24th. So let's say by the end of April, volatility comes back down. If this stock does rally to 275, I'm looking at a 225% return on a $1,300 risk. Now, I'm not sure it'll rally all the way up to 275. I don't know what price targets you have, but even on the conservative side of maybe 260, you're still making a decent return if the stock rallies 20 bucks to 260. Conversely, if the stock makes a crack back at the 215 lows, you're risking pretty much all of the money, the $1,200. So this really comes down to what your thoughts are on the fundamentals of this company, which I don't particularly have a strong view on per se, which is why I was looking at Pfizer. Same type of strategy here. This stock has really been trading within a pretty tight range between $40 and $43. So I do think that perhaps earnings may bring a bit of volatility back to this, maybe up to that 44.5 level. So if I was looking at 44.5 as my price target a few days after earnings, which is April 30th, so let's say a week after earnings, volatility comes down and this stock makes a crack up at 44.50, which is that prior high, 117% return on a stock on a $115 risk. And controlling 100 shares of this will cost me $4,200. Buying one call option will only cost me $115. So this call option is pretty cheap. That's why it's got a score of 94, and this call spread's got a score of 110, because these call options are really cheap. So, and let's take a look at put options instead. Put options, on the other hand, are actually quite expensive. So sometimes that also tells us a little bit, is the fact that people are paying more for puts than they are for calls. That means that maybe there's a higher anticipation that the stock will drop as opposed to climb on earnings. So let's take a look on the downside. What happens if this stock goes back down to about $40 to the downside a few days after earnings, and volatility comes back down? So as you can see, these puts are much more expensive. So now I'm only making a 95% return as opposed to about 120, 130 on the upside. So because the puts cost a little bit more money, even if I'm right, I'm going to make a little less money on this. But sometimes, you know, the markets are telling you something. When calls are really cheap and puts are really expensive, that means people are paying more so for that downside protection than they are for paying for that upside. So some of the things to think about as you look through these examples. Kellogg. This is a stock that I've been following recently, because this is a stock certainly has been a very weak stock over the last few years, and has underperformed severely as the markets rallied since that December low. As you can see, after the markets rallied, the stock not only didn't rally, actually continued to make new lows, but recently just started to climb back up above that 56 support level, which was a major support level. I do think that there's a possibility that this stock will make a run back up to about $60 over the next few weeks, and having earnings coming up on May 2nd may be a catalyst for that. So looking at Kellogg here, if this stock rallies up to about $60 on earnings, reports earnings on May 2nd, so let's say on May 8th, volatility comes down a little. Here, as you can see, even if the stock does rally up to $60, I'm really not making much. 46%, 50%, nothing like the returns that we're currently seeing on some of the other stocks. So, you know, you have to ask yourself, is this even worth it? Meaning, how far does this stock need to go before it's worth taking a look at? So the stock has to rally all the way up to 62 before these returns start looking interesting. So, you know, that's when I would ask myself, do I think it'll go all the way up to 62? If the answer is no, then probably this is something that I might pass on. So using these tools really allow you to plan for your trades and not just think about, hey, I'm bullish, so let me buy a call blindly. Use the P&L simulator. See if the outlook that you have on the stock will produce a return that's attractive or not. Because if it's not, you should probably walk away. So in my particular case, you know, this is one that I would probably walk away from, even though I'm quite bullish on this particular company. Let's look at Electronic Arts. You know, this is one sector that I'm quite bullish on as well in the technology space. I guess I'm not sure if this is still in the technology space or this is now in the communication space, but gaming has certainly been a very, very active subsector, if you will. And, you know, this stock just recently was also happened to be a bullish trade idea today. That's a bit of a coincidence, but, you know, I do think that this stock would probably make a nice crack at that at that recent high around 110 or so. So if the stock does rally up to 110 a few days after earnings, which is on May 7th, so let's say on May 13th, volatility comes back down a little. As you can see here, calls are pretty expensive. So again, my returns aren't super attractive, 63%, 75%. I would say this is probably the bare minimum that I would be looking for this to be a profitable trade for me. You know, the stock really would have to make a crack at a new high around 112 maybe. Yeah, around 112 before this is interesting for me. So again, probably not at the top of my list in terms of trades, but I do think that there's a high probability the stock will make a run at about 110 to 112. So, you know, maybe this call spread here on the right might be something that I might want to take a look at, but it's still not what I would consider super attractive. So as you can see, this platform makes it as easy as possible to type in any stock, click on either I'm bullish or I'm bearish, and quickly just take a look at some setups for bullish and bearish ideas, plug your outlook into the P&L simulator. Remember that you want to make sure that you adjust your time frames correctly for the actual earnings date. You want to make sure you select a date a few days after the earnings date, certainly not before, and make sure that you always adjust that volatility slider a little bit down after earnings, because volatility does always come in right after earnings. So this really allows you to quickly type in any symbol and very quickly get a sense for what is your expected profit return on a specific trade, while also keeping in mind what your potential risks are. So with this, I want to thank everyone for taking the time out this afternoon to view this webinar. What I'll do is, I'm going to cut this about 5 minutes short so that I can have a few extra minutes for questions and answers. If you have any questions or have some symbols that you want to take a look at, please type them into the chat window, and I'll try to spend as much time answering your questions and looking at maybe a few other opportunities that you guys want to take a look at. So just please type that into the chat window. And while you do that, I just want to remind everyone, for those of you that do not have access to OptionsPlay, you can sign up for a free 30-day trial. And what we'll do is we have daily trading ideas that are sent to you in your inbox, weekly options educational webinars just like this, weekly covered call reports for those of you that sell covered calls or cash secured puts. And for those of you that are starting out and brand new, we have a free 12-step options trading course for you to learn more about some of the topics that we cover here at OptionsPlay. Any questions regarding anything that I just spoke about here today? Raymond's asking me to take a look at GE. This is an interesting stock because this stock is trading just above that $9 support level. I was looking at this yesterday, actually. And this stock reports earnings on April 30th. So the question is whether or not you think the stock will rally, or you think the stock's really going to fall back below that $9 support level. So Raymond, do you have a bullish or bearish view on GE? Okay, so you have a bullish view on GE. So let's take a look at that. I'm bullish. So buying a call option is fairly expensive because you can buy 100 shares for $911. Buying a call option costs you $69, which is a fair percentage of the underlying stock. But let's take a look at this, because I think if you're bullish on GE, you'd probably expect to pop up to at least $10 or so. So at $10, a week after earnings and volatility comes back down, not what I would consider super attractive returns. This stock would really have to make a crack at about $10.50 maybe. Yeah, so $10.50, which is that prior resistance, is really where things start to get a little interesting. Now, I do think that, it was just trading at $10 last week. So, for this to pop up to $10.50, I don't think is that crazy of an idea. But if it only makes a move to about $10, as you can see, that it's not as interesting. So I guess the question is, how bullish are you on this particular stock? Serge is asking to look at IBM, which reports earnings in 5 days. So Serge, I'm presuming that perhaps you're bullish on IBM. Maybe you think the stock will make a crack at about 150 or so, let's say a couple of days after earnings here or there. And the volatility comes back down a little. As you can see, about a 50% return. So not super attractive again, in my opinion. So what this is telling me is that these calls are not cheap. So you do have to have a pretty decent move in your favor before things start to look interesting. So as you can see, the stock has to move out to 152.5 before you start looking at roughly about 100% returns on these types of call options. So the question is, do you think that this stock will make a move up to about 152.5? If you look at the previous earnings, it jumped from 123 to 132. So that's about a $10 move. So that's not crazy. So just keep that in mind. Paul is asking, how early do you think you should buy a call or a put on earnings so not to get caught with high vol? Really good question, Paul. The problem is that pretty much, I would say about a month and a half before earnings is really when vol starts to creep up. Now, you don't want to go that early, because then time premium is just going to eat away at your profits. So you usually want to buy these no more than 1 to 2 weeks out before earnings. because if you buy them out more than 2 to 3 weeks before earnings, you're just hanging on to time value. You're losing time value. So you do want to typically buy these closer to earnings, even though volatility is high, because you're going to reduce the amount of time premium that you're going to lose on that particular trade. Does GE make Boeing engines? That's a really good question. I'm not 100% sure, but I'm pretty sure that Boeing does buy some engines from GE. Now the question is whether they've spun that out from GE or not. If I'm not mistaken, I do remember seeing something regarding GE spinning part of that business line out. So I would do a little bit of research on that. Will daily play ideas on spreads continue during earnings season? Yes. So we actually do trade some of these debit spreads going into earnings, and I believe I have one right now in Activision. We are long Activision, and this reports earnings on May 2nd, and I believe that expires before earnings. So yes, we absolutely trade these debit spreads going into earnings, because debit spreads is a great vehicle to allow us to take that directional exposure with limited risk. So yes, we do that. So Roger's saying, does the options play score primarily indicate whether an option is expensive or cheap, or does it mainly indicate other things? No, it pretty much indicates whether an option is cheap or expensive. So, when you have a low options play score, that's telling you that this option is fairly expensive to buy. So as you can see also, if I was to sell this option instead, I get a very high options play score. Because this option is very expensive, if I'm selling it, it looks much better. So this is really where the options play score not only accounts for whether it's cheap or expensive, but also whether you're buying or selling it. When do you decide to buy a put and a call, same expiration date? So I think the question is, when would you buy a straddle? And here, I'll set one up for you, and I'll tell you why I almost never ever buy straddles, or I certainly would never buy a straddle, because you are effectively doubling let's just set it up here first. So the question is, when would you ever buy a straddle? And the reason that I would never buy a straddle is because of this particular slide. So we talk about volatility crush working against you and time decay working against you. When you buy a straddle, you've effectively doubled both of these factors by 2, because not only do you have the volatility crush working against you on the call side, but also on the put side, and time decay is working on you on the put and the call side. And now, even though you will be able to call out a big move, but this move now needs to be double the amount in order for you to be profitable. So this is really where, as you can see, if I bought a straddle on Apple, this stock needs to move between 184 to 215 just for this to be profitable. So that's really where, as you can see here, if you have this volatility crush that works against you prior to earnings, so even if the stock makes a huge move to like 220, here I'm only making a 33% return on the straddle. So even on a huge move, I'm making, I wouldn't even take on this type of risk, because you're risking $1,500 to make $500 in a best case scenario, in my opinion, versus most other cases you'll end up losing money because of that time decay and that volatility crush working against you. Is using straddles a good idea? So I just talked about it. I don't think using straddles is ever a good idea. If anything, for those of you that are much more sophisticated, selling straddles is an interesting strategy. And this is something that a lot of professionals will do, is selling a straddle, because they're basically thinking that the stock is not going to move very much. And as long as the stock doesn't move very much, I'm able to collect a lot of premium going into earnings. So especially if the stock doesn't move, let's say by April 5th, volatility crush come down, and even the stock moves a little bit against you down to 190 or up to 210, you're still going to be profitable on the strategy, because you basically get the inverse. Both the volatility crush and the time decay are working in your favor, doubled, and as long as the stock doesn't make a huge move, you're able to make money on that. How do you read Disney? So Disney is an interesting, this is a subsector that is certainly seeing a lot of strength. With the consolidation in this industry and kind of the move over to streaming, these companies are actually doing quite well, and Disney certainly has had quite a few blockbuster movies that have really that they've been able to benefit from. And as you can see, the stock really was, trading with this 115 resistance level that it finally broke out above. So I certainly think it'll make a crack at that 120, possibly even a little higher on earnings. So let's say the stock makes a move to 125 on earnings a few days after earnings on May 15th or so, and volatility comes down here. I'm looking at 100 and 110% returns on these types of strategies. Even though these calls are quite expensive, you are seeing a pretty nice return on these specific trades. I don't know what your views are on Disney, but I certainly think from a sector and subsector perspective, there is quite a bit of strength from these types of names. Oh, sorry, there seems to be a lot more questions over here that I seem to have forgotten. Sorry about that. So Bob's asking, please kindly give a link to your webinar for replay. So please, if you just go to the chat window and sign up at that link, we will send you a link to all of our previously recorded webinars. What about credit spreads? The reason that I would never sell a credit spread going into earnings is because you have negative risk to reward ratio on a credit spread. So when you're wrong on a credit spread, you're going to risk a lot more money than you're going to earn on a credit spread. A credit spread is really a strategy where you don't think the stock's going to make a move, and that's generally not the environment that you expect out of earnings. You do expect the stock to move during earnings. So credit spreads make money when you don't move, so when you're expecting a big move, you should not be selling credit spreads. What about using straddles? I think I already talked about doing that. Alfred's asking, how do you pull up RSI? Great question. You can click on the expand button for any chart, and you can use the studies and select popular indicators such as RSI. You can even customize your own period for RSI and click on create, and that will draw the RSI for you on a chart. Mitch is saying, how do you avoid selling puts and calls during earnings? And why? So I typically avoid selling cover calls and cash secured puts going into earnings because, again, for the same reason that you wouldn't sell a credit spread going into earnings, because selling a cover call or selling a cash secured put is a strategy that you would deploy when you think that the stock's not going to make a big move. And earnings is really where you do see the largest moves. So that is why selling puts and calls is the same reason why, generally speaking, you don't trade those strategies going into earnings. Will deep in the money call or puts reduce risk in vol crush? No, it won't reduce the risk in vol crush, but it will reduce the risk in time decay. So if you buy a really long dated option, you will have less time decay, but you won't have necessary. Well, I take that back. So long dated options will be less sensitive to that increase in volatility. So yes, so deep in the money. Oh, you're saying deep in the money calls. So no, deep in the money calls are not any less sensitive to vol crush. Further dated calls are less sensitive to vol crush. So if you're, instead of buying a May option, you buy a November option, those options will be less sensitive to Vega. But out of the money or deep in the money do not necessarily make them less sensitive to Vega. What is the significance of the circled number? So again, the circled number is telling you the risk to reward of each strategy, or the potential risk to reward, which is considering how much risk do you have and how much reward do you potentially have, and giving you a single score that allows you to compare different strategies side by side. You can think of it as telling you whether an option is cheap or expensive. Would selling a put credit spread also be good prior to earnings, such as on Boeing? I think I discussed this. So, again, even though that this is generally speaking the right environment to sell credit spreads when vol is high, you don't want to do it ahead of an event that will generally potentially have adverse effects on your strategy, because if you do that, you're going to you're basically risking a lot more money than you can potentially make, and there's no reason to do that. There are far better strategies to trade than to risk more money than you are potentially making on an earnings play. How would you set stop loss orders since the expected time frame for the trade is short? I'm not sure how the time frame has anything to do with the stop loss order. You'd place a stop loss order regardless of whether this is an earnings play or not an earnings play. So I'm not sure what you mean by that question. If you want to rephrase it, I'm happy to answer that. So I think those are all the questions that I have here. A score of 10 bullish, the same as score of 10 bearish? Ray, I'm not sure what you mean by that question. The technical score goes from 1 to 10. So 1 are the weakest stocks in the market, 10 are the strongest stocks in the market. Serge, thank you so much. I really appreciate it. Bernard, what are the minimum and maximum numbers that OptionsPlay can give you on the trades? So this really, it's a risk to reward ratio. So technically there are no bounds, but it ranges between 0 and 250, generally speaking. So when looking for sells, tech score should be 1 for best. So that's relative strength tells you how the stock is performing historically compared to the overall market. So I do tend to find that the ones are the most oversold ones. So sometimes the ones actually aren't the best. Sometimes the 2, 3s, and 4s are actually better so for example, GE, this is one of the worst performing stocks in the market. So those are the stocks that have actually, in my opinion, a higher probability that they're going to bounce higher versus a stock like, what was the stock that I just had out? Boeing, a score 4, it's a weak stock, but it's not the weakest stocks in the market. So these are ones that probably have a higher probability of moving lower. One are the ones that are kind of at their extreme already. So it's probably a little too late to go short those stocks. Roger, thank you so much. I appreciate it. Any last questions before I sign off for the day? Bernard's asking, is there a way to make a search such as selling puts on companies with a score over 100? So selling puts is a strategy for stocks that you want to buy. I wouldn't go selling a put just because it's relatively expensive, because you're going to end up owning a stock that you don't want to own. So I don't recommend you to go shorting puts just because the puts are expensive. I would only short puts on stocks that you actually want to own, because that's truly what selling puts is for. Any other questions? Raymond, I'm really happy to hear that you're better prepared for trading earnings season. I thank you so much for participating every single week. Thank you so much for everyone for taking the time out this afternoon. Bernard as well, Claudio, I appreciate you guys and taking the time out and coming to us every single week, learning more. Next couple of weeks, we're going to do 2 of my favorite topics, debit spreads and credit spreads over the next 2 weeks. So really, these 2 strategies are at the core of most of my trading because of the fact that they allow you to take different types of directional views as efficiently as possible. So we're going to talk about trading credit spreads and then trading debit spreads over the next 2 weeks. So I really hope to see you guys participate over the next 2 weeks. And I hope everyone has a great afternoon. I will see you guys next Thursday. Have a great evening.